George Herman from Citadel Asset Management, who joins us from Cape Town. George, thank you very much for your time. And of course, picking up on the debate that we've just been having with Gina about the global risks, I know that you certainly have a view on the US and where the US is going. And it's not one that involves a double dip recession, is it, sir?
No, not at all, Bronwyn. Good evening. Indeed, you know, the American consumer has proven to be exceptionally resilient throughout this last century. Following every tough period, they've bounced back very quickly. In any case, whilst a fountain is available of free cash, corporate earnings are still growing, the consumer's position is slowly but surely improving, and hence the housing market shouldn't fall out of bed. And if that doesn't happen, we see that the US don't go into another leg of the recession.
Now, George, how are you putting this into the portfolios that you manage? You know, I wouldn't say a positive outlook about America, but certainly not a disastrous outlook. What are you doing in the funds to get some exposure to this?
Wayne, the important thing there for us is to make the decision whether we're going to go into a cycle of deflation, because that's the one thing we have to worry about. So we look at that very closely, but I mean, the same things you look at to find inflation is where you look for your deflation as well. We think that with Ben Bernanke being schooled in that field of expertise, they've been doing everything to avoid this. So for now, we're not worried about deflation. So if that's the case, then surely you want to push towards equities. If we look at relative valuation levels, then obviously equities is our favorite as well. So slowly but surely, being contrarian value investors, we are turning the clock closer to risky investments.
George, obviously after the weekend, we came back to the markets, which rallied, assuming that the Greece crisis was over, or the Greek crisis rather was over. Do you believe that we are going to continue talking about Greece for some time to come? This rolling over of debt is just buying time, so to speak. It's not going to take the problem away?
Absolutely, but Greece is not the only country with that problem. In fact, our big United States is the leader on that front. But in any case, so no, we're not going to stop talking about Greece, but we're wasting our time. Greece is not the issue. I think the markets have learned from the Lehman's issue way back in 2007. And hence, we're not going to find that type of default and just letting something fall over and lead to other dominoes falling over as well. So I think the markets have learned pretty well, and the politicians do understand that as well. So I don't think Greece is the issue. I don't think Greece is going to have a major impact on the markets, no.
Well, let's bring it now to the Optima fund from Citadel Asset Management, and how you are trying to put all the theories out there into action from a strategy perspective. Firstly, being a multi-manager, how are you selecting your fund managers in this environment?
Well, Bronwyn, our investment philosophy rests on 4 pillars. Firstly, that value investments, the investment style, value investment style makes sense. Secondly, that asset allocation is the most important determinant of returns. Thirdly, that diversification does lower risks. And finally, that the future will surprise. So we don't try and be too smart, just understand the story. Now, our growth portfolio consists of equity allocations, both domestically in South Africa and in global equities. But then we have to manage the downside risk very importantly. Citadel cares for the wealth of families, and hence wealth preservation is exceptionally important. And that's why we also have hedge funds in our growth portfolio, both South African hedge funds and international hedge funds. And then the domestic equity portfolio, we refer to that portfolio as Optima. Now in that portfolio, we only put value managers. So you can guess the names in there, but that's not too important. For us, it's adherence to that philosophy, understanding what they do. People who stick to that even through the tough times, and probably the toughest times for value managers is in strong bull markets. But that's when you really see the steel of them, the willingness to be contrarian, to take on risk, not to be benchmark cognizant, and really to have conviction of their views. We don't mind relatively concentrated portfolios as long as we see that they stick with the views, that they don't churn around and waste money.
George, what are your two main? What are your two main important? Sorry, George. What are your two main important themes that you see in the portfolios now? I mean, obviously a multi-manager, you're a combination of different managers, but what are the two big overriding themes or viewpoints that's in your fund at the moment?
The first one is that we're seeing some gold counters coming into our portfolios, which always surprises me. But I reckon that after all these years that at last some of them are starting to show some value. But then the other thing is that resources are becoming a bit cheaper, and some more of those names are coming into the portfolio or increasing in value in the portfolio, more so than the consumer discretionary shares.
Just looking at your performance, George, and of course your benchmark here is the FTSE JSE All Share Index, and I look at your performance over a 7-year period. It's not as though you're shooting the lights out against benchmark. Would that be a fair assessment?
100%. We're not trying to be the star performers in any group in that portfolio. The purpose of that portfolio remains to deliver the asset class's return, but to dampen the downside. And that happens via the value style of investment. If you also look at that portfolio, you'll see that it typically lags the JSE during strong bull phases, but then it outperforms immensely during drawdowns. In fact, during calendar year 2008, the equity market was down 23%, that portfolio was down 16%. But if you go right into the dip of our bear market, where the equity market, the JSE, was down 40%, this portfolio is only down 20%. So this portfolio is very defensive in its style. So do bear in mind that the period that you're looking at, this portfolio is 10 years old. Our market has increased immensely during that period, so you kind of expect it to stay slightly behind.
George, do you do any overlying asset allocation? Do you use derivatives to implement a particular asset allocation view, or do you allow that purely at the discretion of your underlying managers?
Wayne, firstly, the asset allocation decision, as I said in our investment philosophy, is exceptionally important at Citadel, so we spend a lot of time on that. So we do actively make changes in our overall asset allocation. And seeing that we monitor up to 33 asset classes, that keeps us pretty busy. We also don't move money around unless it's material and that it's going to make a difference, so we don't make small changes on the margin. Yes, the mandate of that specific portfolio does allow for derivatives or tactical asset allocation overlays. Not much of that has happened. In fact, the last time it happened was at the height of the bull market, and it actually gave away a little bit some of the last strength of the bull market.
George, I need to jump in here because we are running out of time, and I know we need to talk about inflation. You've got very strong views on inflation in South Africa and certainly the risks to the upside on this front. Sir, your final comments are going to have to be around your stance on inflation in South Africa.
But just internationally first, two comments. Internationally, we're not that negative on inflation. We see that dampening down. But in South Africa, just 2 points that our economic analyst Salumi does fantastic work. What she done, she stripped out petrol because all of the exogenous factors, and then show the effect of administered prices on South African inflation, and that number is a double-digit number. Doesn't matter what happens, and that's a problem because it puts a lot of weight into our CPI, and hence will put upward pressure on CPI. The second point is that our wage adjustments is just not reflective of what's happening in the world. If you look at the last economic recessions over the last 10 years, all over the world, you would see that wages adjust downward along with economic cool down, but not in South Africa. If you look at remuneration per worker, it literally just keeps on increasing irrespective of economic activity, and that is a very worrying sign for longer term inflation implications in South Africa.